Okay,
Oh,
so when you
okay.
start a policy today, there's a really big death benefit. This does go up. That's not crooked. That the death benefit will go up in value each year.
Hmm.
You also have what's called cash value, which as a real estate person is I talk about like it's like having equity in your home. Cash
Okay.
value is equity in the policy that you could use. Totally different than a HELOC, and this is the cool part. When you take a loan from the bank, like a HELOC, number one, you have to get approved.
Yeah.
Usually, it's a floating rate that changes often, and you have monthly payments each month. You also have a credit report where the HELOC shows up on your credit report, and if you don't pay for it, we can get in a lot of trouble.
Yeah.
Life insurance is totally different. So with life insurance, there's no application. It's a phone call to get the equity. There's no monthly payments. Right now, it's a lower interest rate to borrow than a HELOC, and this changes annually, not monthly. And there's no reporting.
What do you mean with no payments? You have to pay for the interest at least, right?
Nope. So this is cool. Hopefully, light bulbs will go off here. Watch this. So when you want to buy when you want to use your life insurance to buy the rental, which eventually we want to get you to that point where you're not using a HELOC.
Yeah.
So if you use the life insurance to buy the rental, you have two options. First, you can take money out. So let's say you have cash value, you can take money out of the policy, and then what happens to the growth? Well, it starts over.
Yeah.
And long term, it's killed. That's called opportunity cost. It costs you a lot of money by spending your money. I don't want to spend my money. I don't. I'm so cheap. I'm not even going to leave money to my family. The insurance company is going to leave money to my family. So,
Okay.
so here's what you do. You don't take it out. You borrow against. So here's how this works. Let's say there's $1 million and there's 200K in cash. It's $1 million death benefit. The insurance company is already on the hook for $1 million. If you die, they owe $1 million to Rodrigo.
Okay.
You call the insurance company and say, hey, without an application, I want to borrow money against the death benefit. If you die with the loan outstanding, the 200,000 comes off the death benefit.
Okay. Hmm.
Sorry, Rodrigo, you got $800,000 tax free. This is what I was saying. If something happens, he can use that money to keep up on the rentals or pay off the mortgage or do whatever he wants with it. He's recouping tons of cost.
Yeah.
So the worst case scenario, okay?
Yeah.
The insurance company doesn't recognize your loan. So they're going to continue to pay you dividends as if all of the money was inside the policy.
Oh,
It's
okay.
just like when you Blue Ridge, you have debt on Blue Ridge, you have a mortgage.
Hmm.
Well, the account value, the house value can still be going up
Hmm.
because of the market, which I
Yeah.
think it will over the next 10 years. They don't. So the value of the asset, my life insurance, my real estate, has nothing to do with whether or not I've borrowed against it.
Yeah.
Why I love life insurance is because there's no monthly payment. I could keep a loan outstanding for 2 years. I'd like to pay the interest. Don't get me wrong. I want to pay the interest just to keep up with it. But even if I don't pay the interest, when I die, the 200K plus the interest comes off the full million.
Yeah.
And when I put the money back in, when my renters pay me back and I'm starting to pay off my loan, I now have more cash in my policy than when I started. If you use a mortgage company, let's say you buy a house, the mortgage company puts in 80%, you put in 20%, but your 20% comes from your death benefit, your dead self puts in the 20%, you have no money involved. You didn't provide the mortgage, you didn't provide the down payment, you have zero money invested in
Yeah.
this property, which gives you what? An infinite rate of return.